In this lesson, we're going to discuss the income statement. The income statement is a financial statement, and it summarizes the firm's performance over a period of time. If it's an annual income statement, then it summarizes the firm's performance over the year. If it's a quarterly income statement, then it summarizes the firm's performance over the quarter. In a principles level finance course, most of the income statements we're going to be looking at are annual income statements. When we looked at the balance sheet, we said that we can think of the balance sheet as being a snapshot of the assets we have and how we finance them, which would be our liabilities and our equity. Since the income statement is summarizing the performance over a period of time, we can think of the income statement more like a recording of what's happened over this period of time, instead of a snapshot like the balance sheet. So it tells us what happened over the course of this year, or what happened over the course of this quarter, depending on the type of income statement we're looking at. The basic income statement equation is net income is equal to revenues minus expenses. So when we're constructing an income statement, we start with revenue, and all we do is subtract our expenses. That leads us to net income. In your accounting classes, you probably saw a more complex income statement than just revenues minus expenses. And we'll look at a simple income statement, but we do organize the expenses on the income statement in a way that allows us to compare performance across firms and compare those firms' expenses. The way that we organize them also helps us to see what's tax deductible and what's not. So here's what a simple income statement looks like, and this may be what you saw or something similar to what you saw in your accounting classes. So we start with our sales or sales revenue, or sometimes you'll see that it's called net revenue. Sometimes you'll see it just called revenue. Then we subtract our cost of goods sold. Now here we can have a subtotal called gross profit. We don't have that here because this is a more simplified version of an income statement. Another thing I'll note is that in your accounting classes, you may have seen costs broken down into variable cost and fixed cost. You may have seen general and admin expenses. You may have seen a line item for other costs. But in this simple template, we're just going to have sales minus cost of goods sold. Then we subtract depreciation and amortization. And that leads us to the subtotal EBIT, earnings before interest and taxes. This is also called operating profit. If we call it EBIT, or earnings before interest and taxes, that's really helpful because it tells you what you need to subtract next. So the next thing to subtract, if we've got the earnings before we've subtracted interest and taxes, then the next thing that we subtract is interest. Once we've subtracted interest, we have a subtotal, earnings before taxes, or EBT. We also call this taxable income. Either way, the name of that subtotal lets us know what the next step is. We need to subtract taxes. So we'll calculate our taxes if we have to, then we'll go ahead and subtract them here, and then that gives us net income, which is also sometimes called net profit if it's positive, or net loss if it's negative. Net income belongs to the shareholders, and here's where the board of directors decides how it's going to be paid out to the shareholders. They can decide to pay the shareholders a dividend, so we've got net income minus dividends, and whatever's left over gets reinvested into the firm, which would be the addition to retained earnings. That moves into the balance sheet under accumulated retained earnings. Remember that accumulated retained earnings on the balance sheet is under equity, and equity is shareholder money. So whether we decide to give net income to the shareholders as a dividend, or whether we reinvest it in the firm under equity, either way, it's shareholder money, so net income belongs to the shareholders. A couple notes about the income statement and generally accepted accounting principles is that the income statement does not tell us how much cash flow the firm has. The recognition principle tells us that revenue is recognized on the income statement at the time of the sale. This is not necessarily when cash is collected. If we give our customers 15 days to pay or 20 days to pay, then we've recognized the revenue when we made the sale, but our customer won't pay us until 15 days or 20 days or 30 days later, depending on the terms that we gave them. Even if we don't give our customers any time to pay, if we make an online sale, depending on our payment processing company, we may not get paid for that sale for another day, another 2 days, another week, another 2 weeks, depending on the terms that we have with that payment processing center. This means that sales revenue is not necessarily equal to cash inflow because they happen at different times. Similarly, the matching principle tells us that expenses are recognized at the time the associated sales revenue is recognized, so when the sale is made, not necessarily when cash is paid. This means that our expenses also don't equal our cash outflow. So since our sales revenue is not necessarily equal to our cash inflow, and our expenses aren't necessarily equal to our cash outflow, we're back to net income is not equal to our cash flow. So it's important to recognize that when we're looking at net income, we could be profitable and have a positive net income, but we still need to manage our cash flow. And we'll talk more about that in a later chapter. Here's a simple income statement so that we can see how that works. So we've got sales revenue of $1,000. cost of goods sold of $650, and depreciation of $75. Notice that there are no negative signs here. In the earlier income statement template, we did have negative signs. But even when there are no negative signs, because we know that the basic income statement equation is revenues minus expenses, we should automatically assume that we are subtracting these figures. So 1,000 minus 650 minus 75 leads us to earnings before interest and taxes of $275. Then we have interest expense of $100, so if we subtract that, we're left with earnings before taxes or taxable income of $175. If our tax rate is 21%, we multiply 21% by $175. So that would be 0.21 times $175. That gives us $37 if we round. So if we subtract our taxes of $37 from our taxable income of $175, that leaves us with net income of $138. So we've earned $138 for the shareholders, and now as the board of directors, we decide how to pay that out to them. So if we decide on a $30 dividend, what's left over is $108, which is our addition to retained earnings and feeds into our balance sheet into accumulated retained earnings, which is equity and still belongs to the shareholders. Then we can close out the income statement and start new next period.